This is going to be a huge week for the markets, as Google, Meta, Microsoft, Apple, and Amazon are all reporting their 2023 earnings. In this video, I want to share my thoughts on the largest earnings releases this week and which ones I'm going to be paying the most attention to. There's also some things investors need to know before Google reports today, so I will be covering that in this video. I also do my best to cover as many of the earnings as I possibly can during earnings week. So if you would like to stay up to date with earnings, then subscribe to my channel. And lastly, my book, The Fundamentals of Investing, is done. It's currently being reviewed by Amazon, and if all goes well, then it will be available on Amazon by next week. I will do a video here on my channel when my book is available on Amazon, so make sure to stay tuned for that one as well. But with that being said, let's hop right into the video. Alright, so the first stock that we are going to be talking about is Microsoft, which reports its earnings after the close today. Microsoft is officially a $3 trillion business now, and the stock just continues hitting all-time highs. From its lows here in November of 2022, the stock is also up 91% now, which means that it has nearly doubled. Now, in terms of Microsoft as a business, I am actually expecting a pretty solid earnings report from this company. Overall, their business is performing incredibly well. They're seeing strong demand for their cloud services and all of their products. And the business overall just seems like it is doing incredible and is going to continue to grow. It almost seems obvious to investors now that Microsoft's business is going to be growing consistently over the coming decade. However, the one thing that I do not love about Microsoft's stock today is simply its price. Microsoft is now selling for a price to free cash flow of 48, which is a free cash flow yield of only 2%. Now, the way that I like to think about investing is how Warren Buffett thinks about investing. And what he recommends investors do is ask themselves, how much cash can the business return to you versus the price you are paying for it today? And in Microsoft's case, based on its free cash flows and its price today, it can only deliver back 2% to shareholders at its current price. This suggests that Microsoft's stock is actually quite expensive today. And if we go and take a look at its historical price to free cash flow ratios versus how it's currently trading, it is also on the extremely high end. So if we zoom out here to 2010, we can see that Microsoft is trading for its highest price to free cash flow in over 14 years now. And back here, it was trading for a price to free cash flow of about 7.7. Its average over the past 14 years is also about 22, so it's trading more than double its historical average price ratios. This once again suggests that Microsoft stock is actually quite expensive today, and if we even go and take a look at what analysts are expecting for Amazon's earnings per share growth over the next 5 years, we can see that they are expecting about 13.9% earnings per share growth. Now, if we head over to Stock Unlock's discounted cash flow calculator and we project out the earnings for Microsoft over the next 5 years, with that 13.9% growth rate and a 25 price to earnings ratio, then we can see that Microsoft's fair value is about $309 per share. So based on analysts' own estimates and a reasonable price ratio of 25 for this business, then the stock, in my opinion, is selling quite a bit above fair value today and would need to drop significantly before I become interested in it. So heading into this earnings season, I do think that Microsoft is pricing in a lot of optimism, and the stock is actually quite expensive. So if Microsoft does not have some sort of amazing earnings report, then personally, just in my opinion, I don't know if I'm going to be proven right or whatever, but in my opinion, if Microsoft does not produce an amazing earnings report, then I think that the stock is more likely to see some downside pressure rather than upside pressure, because the stock has been running so hard, and as stocks run, it means that they are pricing in a lot more optimism. So personally, again, I think that Microsoft is on the very expensive end today. I am not an owner of this business. I would love to own it at a sane price, but at a 48 multiple, it's not cheap, okay? This is a $3 trillion business selling near a 50 price to free cash flow. That is insane in my opinion, and it actually is kind of confirming that we are entering a little bit of an AI bubble. Because for those of you who do not know, the last time Microsoft was trading for a price to free cash flow this high was actually in the tech bubble. It peaked around a 60 price to free cash flow. That is the highest the stock got during the tech bubble. And then, as I'm sure most of us know, Microsoft's stock then did not produce any returns for about 17 years after its peak here in the tech bubble. It took all the way to about 2016, the end of 2016, for the stock to make a new high. And it's also worth noting that during this 17-year time frame, the stock was growing, or the business was growing. So this is really the risk of buying businesses at extremely high prices, is that if you pay for all of the business's future growth today, then even if that business does end up growing over the next decade, you can still not make any money as an investor. So in my opinion, I think that it is very important to focus on the price that you're paying for your businesses and make sure that you're not buying too much future growth. And right here is a perfect example. So in 2004, Microsoft was producing revenue of about $37 billion. And by 2016, it nearly tripled its revenue to $100 billion. But remember, over this time, the stock still did not see any growth because of how much investors were paying for it in the year 2000. So I do not know if Microsoft stock is at a peak right now or if it is going to continue running. But all I know is that historically, when stocks like Microsoft get to this price ratio, it just means that their future returns decline significantly. So the only problem is I don't know where the top is, and Microsoft stock could continue running regardless of it already being expensive. But when I look 5 to 10 years out, given the historical data of how these things trade and how bubbles form, I just think that Microsoft's future returns over the next 5 to 10 years are going to be quite low. Again, even if the business does grow. So that's why I'm kind of avoiding it. And that's kind of my thoughts going into Microsoft's earnings today. Now we're going to move on to the next stock here, which is AMD. AMD has also been running freaking crazy, and the stock is at an all-time high basically right now. What's also incredibly interesting is that back here in October of 2020, the stock was worth about $56 a share. This means that the stock has ran now over 200% since October 2022, and the shares have just gone crazy. Now, if we take a look at AMD's price to free cash flow, we can say that it is sitting at 216 now, which is just ridiculously high. And we're going to take a little bit of a deeper look right now. So if we head over to AMD's income statement, we can actually see that its revenue in the trailing 12 months has been declining and is not at an all-time high. It's actually down a little bit from its all-time highs in the fourth quarter of 2022. So really over the past year, AMD's business and its revenue has actually been coming down. Now, if we take a look at its operating cash flows, this is the exact same story. And its operating cash flows have actually been declining quite significantly. They peaked here at about 3.8 billion in the third quarter of 2022. Now they're at about 1.85 billion. So the operating cash flow for this business has actually been cut in half over the past about year. Now, if we also take a look at AMD's projections for the fourth quarter of 2023, we can see that they are projecting revenue of about $6.1 billion plus or minus 300 million, which is an increase of 9% year over year and 5% quarter over quarter. So the business does look like its revenue is going to start growing again, but still 9% year over year revenue growth really isn't anything incredible. There's a lot of businesses in the market that are growing their revenues at much faster growth rates than 9% year over year right now. So I think that AMD stock is seeing so much growth because, again, I do kind of think that we are entering an AI bubble, and AMD is kind of benefiting from this whole AI wave because these businesses have to buy NVIDIA and AMD chips. So AMD is kind of a beneficiary of all of these businesses investing in AI and needing the computing power to actually invest in AI. However, when I see a business trading for this high of a price ratio, while its revenues are only growing 9% and its cash flows are actually declining, it tells me that the stock has a lot of future growth projected or priced into it already, which is the exact same risk as what we just discussed with Microsoft. When you pay these high prices for these businesses, even if their fundamentals grow in the future, it doesn't mean that you're going to make money as an investor because you're paying for all of that future growth today. So that is what I think is currently going on with AMD stock. I think it's pricing in a lot of future growth. I think the market is very optimistic on this business as well. So if AMD does not come out with an absolutely ridiculous, and I mean ridiculous earnings report, then I would not be surprised if this stock sees some weakness after earnings as well. Honestly, AMD is at a price right now where I don't even really understand it anymore. And I think that the stock actually does carry quite a bit of risk at its current price. So I am not going to be buying this one. It is actually a stock that I've owned in the past, but at this price, I am just not interested in it at all. And I would really want this business to come down before I even considered it. So that's kind of my thoughts heading into AMD's earnings for this week. Now, the next major stock that we have to talk about is Google. Google is actually finally back to all-time highs. This was one of those stocks where Microsoft and Apple were hitting all-time highs, but Google wasn't really. But now Google is officially at all-time highs. And there is something very important to watch out for in Google's earnings report that is going to come out later today that I don't know if a lot of investors are aware of or are factoring in. So I'm going to explain that in this video now. But first, let's take a look at Google's financials here really quickly. So Google's revenue in the trailing 12 months is actually hitting a brand new all-time high. And the business's revenue growth has started to re-accelerate. It was kind of flatlining there for a few quarters, but here we can clearly see that Google's revenue is starting to grow and is back on the uptrend officially. Now, if we head over to the company's cash flow statement and we take a look at its operating cash flow, this is the exact same story. Google's operating cash flow has been growing massively over the past couple of quarters and is now sitting at 106.45 billion. We can see that its previous high was in the first quarter of 2022 at 97.5 billion. So this is all great to see. However, take a look at this right here. This was in Google's third quarter 2023 results, and this says, on October 16th, 2023, we made an estimated tax payment to the IRS of $10.5 billion that will be reflected in our fourth quarter operating cash flow. So Google was actually deferring a $10.5 billion tax payment to the fourth quarter of 2023. Now, what this means is that its cash flows are actually artificially high right now. So this $106.5 billion in operating cash flow is so high because Google was deferring a $10 billion tax payment to the fourth quarter that will now be lowering the company's fourth quarter operating cash flow by $10 billion. So if we actually factor in this $10 billion tax expense, then Google's operating cash flow would be about $96.5 billion, which is actually not at an all-time high because the previous all-time high was $97.5 billion. So basically, if we factor in this deferred tax payment for Google, then its cash flows aren't as impressive as they seem. And I am fully expecting Google's operating cash flow when they report today to be down year over year for the fourth quarter. I don't know about the full year because they may have a very strong quarter, but when they factor in this tax payment, it's going to be very hard to not see the year over year operating cash flow actually decline. Now, also what this means is since Google's cash flows are being artificially inflated right now, it means its price to free cash flow and its price ratios are being dampened down. So if we go and take a look at Google's price to operating cash flow, and we just zoom out here to about, let's say 2010, why not? We can see that historically, the price ratio has peaked here around 20 to about 22. That has been the high end range of Google for its price to operating cash flow. Now, when we factor in the $10.5 billion tax expense to its trailing 12 months operating cash flow, the business is actually selling for a 20 price to operating cash flow today. What this means is that when you factor in this tax expense, Google is actually selling near the top of its range, at least historically. Or in other words, this business is actually kind of on the expensive end. So I don't actually think that Google is a very cheap stock today. And if I had to guess, I would say that the stock is actually selling slightly above fair value. And I honestly have no idea how the market is going to react to Google's earnings report today. But since the stock is kind of selling above fair value when you adjust the numbers to reflect more of reality, it is on the expensive end, which means that there is optimism priced into the stock, which also means that if Google does not have a great earnings report, then I would not be surprised to see the stock drop after earnings as well. I do think that it is going to kind of need to beat expectations to keep the stock continuing to rise. That's just my opinion though, and that's kind of what I am expecting for Google before earnings today. Now, the next stock that I am watching is CP, and this is actually the most recent stock that I was adding to the YouTube portfolio because I thought that the stock was undervalued and cheap relative to its future growth trajectory and the strong moat that this business has. CP is one of Canada's two major railroads, and in Canada, there's kind of a duopoly between CNR and CP, and I just think that this is one of those businesses where it's going to be around for the next 100 years, almost guaranteed. I do not think that trains are going to be disrupted by any new technologies or anything like that. So the existing train and railroad companies, I think, are going to be around for the extremely, extremely long term, and they have some of the best moats that I have ever seen. So it's one of those stocks I really don't worry about in my portfolio as long as it is not getting stupid expensive, which I do not think that CP is today at all. CP also recently did a large acquisition of Kansas City Southern, which is dampening the company's earnings over the past 12 months. And the company is kind of having to go through these operating efficiencies and pull some efficiency levers to get the margins back up. So basically, CP's margins are actually depressed right now, which is why the price to earnings ratio is higher at 23.7. But once these operating efficiencies are done and worked through, then I think that the company's earnings are going to grow quite significantly. And actually, the business is projecting 10 to 12% annual earnings per share growth over the next 5 years as it continues working through these efficiencies. That's pretty strong earnings growth. And really all I'm looking for in this earnings report is to continue seeing margin expansion and to continue seeing the operating efficiencies being worked through. That's really all I am looking for. And I do truly plan on holding this one for the long term, as long as it doesn't trade for a 50 price to free cash flow or price to earnings ratio. If it does that, then that may be a different story. But for the moment, I am very much so planning to hold this one for the long term and just let the business continue doing its thing. So that's all I'm really looking for in CP's earnings report today, is just a continued improvement of margins and efficiency. All right, let's move on to the next major stock that is reporting, which is Apple. This is another $3 trillion business, which currently has a price to free cash flow just below 30, which is a free cash flow yield of only 3.36%. Now, this stock, in my opinion, is also on the very expensive end, and it is not within a range that I would personally be looking to buy at all. I think that it is pricing in a lot of future growth and optimism. What's also interesting about Apple right now is its revenue in the trailing 12 months has not grown in almost 2 years now. It's actually slightly declined. So the business's revenue is in a period where it's not really growing. Now, it is also worth noting that Apple has been in this situation before. For example, right here in 2015 to about 2017, the business's revenue did not grow, and there was a period where it actually declined. Then in 2018 to about 2020, Apple's revenue did not grow once again. So it seems like Apple's business and its growth is a little bit more cyclical, where it sees these massive growth spurts, then the business kind of levels off, then it sees another massive growth spurt again. So Apple's business is definitely in one of these areas where the business's revenue is not really growing. But what's interesting to me is while the business's revenue is not really growing, it's also trading for a 30 price to free cash flow, which is a pretty high multiple. So seeing no growth with a high multiple, in my opinion, is kind of interesting. Now, if we also go and take a look at Apple's operating cash flows, we can see that it hasn't really grown in over 2 years as well. So the business's profits are not really growing either. So what I have noticed, at least in my own opinion, over the past 2 years really, is more and more money seems to be flowing into the largest US companies, regardless of if they're seeing strong growth or not. And this is really what has been happening to Microsoft and Apple especially. The two largest stocks in the S&P 500 and the two largest businesses in America have seen so much money flow into them, and it's caused their stock prices to rise at a faster rate than the fundamentals of these businesses can grow. This ultimately leads to multiple expansion and lower yields on these businesses, which increases the risk of these investments and of these stocks. It also means that these businesses are pricing in a lot of future growth and optimism right now. So if their growth rates do not pick up, then I would personally struggle to see their stocks continuing to rise at a rapid rate. So I don't know what Apple is going to report, but man, if it does not have a great earnings report, then it's another stock where I would not be surprised to see some weakness just because its price ratios are so high already. And I think that there is a lot of investor optimism in the stock already. Now, if we also take a look at Apple's price to operating cash flow since 2010, we can see that it is at a high rate now of 26.8, and its average over the past 14 years has been about 14.6. So it's nearly double its historical averages right now. And this is really what I mean by there has just been so much capital flowing into the largest US businesses, especially what they're now calling the Magnificent Seven. So that's kind of my thoughts on Apple. It's not a stock that I'm really interested in at today's prices. I wouldn't be surprised to see more downside than upside on the stock after earnings, but that is just my opinion and what I think heading into the company's earnings today. All right, now let's move on to the next stock we got to talk about, which is Amazon. Now, Amazon stock is not actually back to all-time highs quite yet. Its all-time highs were right here in 2021 at around $186 a share. The stock is hitting year-to-date highs, but not all-time highs. Now, what's interesting about Amazon is this business is also seeing all-time high growth to its revenues and its operating cash flows right here. So here we can see that Amazon's revenue is at an all-time high and growing nicely and consistently. If we go over to the company's operating cash flow, we can see that it is hitting an all-time high as well. And I love to see this, okay? Because Amazon here in 2022 was like, you know what? We're going to focus back on profits. We're going to get our operating cash flows and our cash flows back up. That's the focus of the company. And then if you take a look at their execution since then, it has been incredible. It has been a total shift in the company's efficiency and profits, and now its operating cash flows are back to an all-time high. Now, what I am expecting for Amazon in the fourth quarter, this upcoming report, is an increase in efficiency and an increase to its operating cash flows. So I am expecting the next quarter for this next bar to be quite significantly higher, and for Amazon's profits to continue growing quite significantly as well. For the fourth quarter, Amazon is also projecting its sales to be between 160 and 167 billion, which is growth between 7 and 12%. So the business is expecting to grow its revenue by 7 to 12% in the fourth quarter. Operating income is also expected to be between 7 and 11 billion, compared with 2.7 billion the prior year. So they're projecting to at least 4x or around 4x their operating income in the fourth quarter, which I do think is a great thing to see. Now, if we take a look at Amazon's price to operating cash flow, this is a very interesting story. And by the way, I focus on Amazon's price to operating cash flow over the price to earnings ratio and price to free cash flow ratio, because this metric has been the most consistent for Amazon historically by far. So in my opinion, this is the metric right here that the market tracks and uses to see if Amazon stock is undervalued. For example, here in 2015, we can see that Amazon stock bottomed at a 20 price to operating cash flow. Then again, here in 2016, it bottomed right at 20. Back here in 2012, it bottomed at 21. So historically, whenever Amazon stock has gotten down to a 20 price to operating cash flow, the market has came in and bought up the stock very, very consistently. Now, what's interesting is Amazon stock is only trading for a price to operating cash flow of 23 today, and its average over the past 18 years has been about 27. So Amazon is actually still selling below its historical average price to operating cash flow ratio, which again is the metric that the market seems to track. This ultimately means, in my opinion, that Amazon is not actually that expensive relative to how the market has valued it historically. And especially if Amazon can continue growing its operating cash flows in the next quarter, that is going to lower its price to operating cash flow even more as the operating cash flow increases. So this 23 price to operating cash flow today may be 20 within the next week, which would mean that Amazon is actually selling near its historical lows again and could potentially push the stock up even further. So basically, if Amazon does come out with a strong Q4 earnings report, then I think that this stock could actually see quite a bit of upside. And I don't think that there is that much optimism priced into Amazon stock today. Not nearly as much as Microsoft and Apple or even Google. So I think that Amazon actually stands to see the most from this quarter's earnings report than those other businesses. And again, I don't think that Amazon is on that crazy expensive end today. And it's one of the only large cap stocks that I think this way. So yeah, that's kind of my thoughts with Amazon's earnings report. That is what I am expecting to see when it reports earnings later this week. Now, the last stock that we have to talk about in this video is Meta. Meta has one of the craziest stock charts I have ever seen. I mean, look at this. It was a $380 stock, and then it fell by, what is that? 76% to $88 per share within like 6 months. And then from there, it's up another 342%. This is crazy, crazy, crazy volatility. Now, if we take a look at the business's financials here and we go to the income statement, we can see that its revenue is starting to accelerate and go back to all-time highs. It went through a period where revenue was not really growing. That period seems to be over, and the business is now growing its revenue once again. This is the same story with the business's cash flows, and its operating cash flows are at an all-time high, which is really good to see. And I actually do think that Meta is going to have a pretty strong fourth quarter report, because right here in the third quarter, they gave their outlook for the fourth quarter, and they were expecting about 18% year-over-year revenue growth. So Meta is actually expecting to see pretty strong revenue growth in the fourth quarter, and with their cash flows growing at the same time, I would not be surprised if this business produces or reports a record amount of cash flow once again as well. So I think that they're actually going to have a pretty solid report, and I think that the business is setting itself up for a solid report as well. However, if we take a look at Meta's price to free cash flow today, it is now sitting at 27, which is on the higher end. And I actually think that this business is now selling slightly above fair value. For example, back here when the stock was absolutely collapsing, it was trading for a price to free cash flow of only 9, which was just insane. It was way too low. And that is when I was dollar cost averaging down, buying my shares of Meta. Now the stock's price to free cash flow has more than tripled to 27. So I don't think that the stock is nearly as cheap as it was historically, or at least back in 2022. However, out of the Magnificent Seven, I do think that Meta is one of those stocks that is it is one of the cheaper ones, but I don't really know how to word this because it's cheaper than the others, but it's not still cheap in my opinion. It is still above fair value. So again, in my opinion, I don't think that I would be buying Meta up here. Well, in fact, I am not buying Meta up here. I would be interested in Meta if the stock does fall again at some point in the future. I don't know if that's going to happen, but I do think that the stock is selling above fair value, so I'm not eager to buy it today. Since it is also selling above fair value, I do think that the stock needs to have a pretty dang good earnings report for the stock to continue seeing momentum to the upside, but that is just my opinion. And again, I do actually think that Meta is going to have a pretty good report. So this is one of the stocks where I'm kind of 50-50 on it. I think that it could go either way. I think that it could see some upside or some downside. But on the other stocks like Microsoft and Apple, I mean, those two businesses really have to knock their earnings reports out of the park for their stocks to continue seeing momentum. And if they have a subpar earnings report, but the stock continues rising, then that's just going to push those price ratios up even more. and get us further into what I think is an AI bubble that is forming in the market. So that is kind of my opinion on all of the major tech earnings coming up this week. That's what I am speculating is going to happen, and all of the fair values and whatnot on these businesses. If you enjoyed this video, then please remember to leave a like on it. And again, I am going to be doing my best to cover all of the earnings reports here on my channel over the next week. So if you want the aftermath of the earnings reports and what the numbers actually were, how everything played out, then make sure to subscribe to my channel and stay tuned this week for those videos. And lastly, my book right here, The Fundamentals of Investing, which is officially on my shelf. It is going to be released within the next week if Amazon finally approves the book. So it's really up to Amazon at this point, but the book, as soon as it's reviewed by Amazon and it's ready to go, I am going to be publishing it. And again, I will make a video here on my channel going through the contents of the book when it is available, so you can know if it is something that you want to purchase or consider. I am very excited to get this book out, and I cannot wait to get it in your guys' hands. But that is going to wrap up the video for today, everyone. Thank you so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next one.